stop what you're doing for 10 seconds. Because if you blink right now, you'll miss the real story behind this silver move. And I'm telling you, it's not the story most people are repeating. We are watching prices do something that, a few months ago, would have sounded like late-night radio hype. Yet here we are, silver trading above the triple-digit line in the US, and even hotter in parts of Asia, where the local pricing is blowing past what most Western investors are even looking at. And the scary part? The price is not the headline. The reason it's happening is the headline. Now, before we go any further, I'm recording this on Tuesday, January 27th, 9:12 a.m. New York time. Comment what time you're watching this, because I love seeing where in the world this message is landing. Also, quick note, the stats on this channel show a ton of you watch these videos but haven't subscribed yet. If you like the way I break this stuff down, hit subscribe right now. It helps more than you think. All right, back to the move. Because what you're about to hear next is the kind of detail that changes how you see the entire market. On the surface, the story is simple. Silver's ripping. Cool, great, everybody claps. But underneath that, the market is acting like it's bracing for something, like buyers are trying to get in front of a door that's about to slam shut. You've probably heard the phrase front-running in stocks, right? People trying to position before an obvious event hits. Well, that behavior is now showing up in physical silver across multiple regions at the exact same time. And when you see that kind of synchronized behavior, you have to ask one question. What do they know that you don't? Because here's what's not normal. You don't get a situation where one country's retail pricing is calm while another country is paying a huge premium, unless supply is getting pinched or confidence is getting broken, or both. And right now, the evidence is pointing to both. One of the biggest tells is what's happening in Washington. Lawmakers have been floating the idea of building a multi-billion-dollar strategic stockpile for critical minerals. Not maybe someday. They're talking numbers. And silver, yes, silver, has been pulled into that conversation, right alongside the metals everybody already knows are strategic for electronics, defense, power grids, and modern manufacturing. Now think about the psychology of that for a second. The moment a government starts treating a material like it's strategic, you change the game, because it's no longer just an investment. It's no longer just a commodity. It becomes a supply security issue. And supply security issues don't get solved by wishful thinking. They get solved by grabbing what you can, when you can. That's why I want you to hold this thought in your head as we go forward. If governments start competing with industry and investors for the same metal, price is not the only thing that moves. Availability moves too. And that's where the real drama starts. Here's the part that people who only watch the spot chart are missing. Price is not a single thing. There's the paper price, what flashes on a screen. And then there's the physical price, the number you actually pay when you try to get real ounces into your hand, into your vault, or into your factory. In calm times, those two prices behave like cousins. They're related. They move together. Nobody cares. In stress times, they become strangers. That's when you start hearing sentences like, spot is this, but good luck finding it at that. And if you think that's just a retail problem, let me tell you, it's not. It's a supply chain problem because manufacturing doesn't run on spot charts. It runs on delivered metal, on schedule, in spec. So when you see big gaps between regions, US triple digits, Asia even higher, you're not just seeing different currencies, you're seeing different levels of urgency. You're seeing different bottlenecks. You're seeing different pipes, and those pipes matter more than opinions. A lot of the time, silver moves around the world because of incentives. If one hub pays more, metal flows there. That's normal. But when those gaps persist, and especially when they widen, it can mean the metal that would usually flow is getting stuck somewhere. Maybe it's tied up in long-term industrial contracts. Maybe refiners are backlogged. Maybe shipping costs and insurance make arbitrage less attractive than it looks on paper. Maybe customs rules slow everything down. Or maybe, and this is the scary maybe, there just isn't enough free metal available to move without somebody else getting squeezed. Because remember, in commodities, inventory is not the same as available inventory. When some bars are spoken for, some are pledged. Some are sitting in places where they're technically counted, but practically untouchable. And when the market realizes that, it doesn't gently adjust. It reprices violently. Now, let's talk about the emotional trap that comes with triple-digit silver. A lot of people see a big number and they assume the move is too far. But too far is not a strategy. Markets don't top because a number feels big. They top when marginal buying dries up, when liquidity returns, and when the reason for urgency disappears. So the question isn't, is $100 big? The question is, what changed that made people willing to pay it? And if the answer is availability, then the next question becomes even more important. What happens if availability gets worse? Because I've seen this movie in other markets. It starts with headlines, then it turns into delays, then it turns into rationing, then it turns into policy. And the biggest mistake people make is thinking policy comes first. Policy usually comes after the pain is already obvious. So when you hear lawmakers discussing a strategic minerals reserve, don't just treat it like political theater. Treat it like a tell. Because politicians don't talk about stockpiling something unless somebody behind the scenes is briefing them that supply is a vulnerability. Now, I want to give you a little fresh context on why silver ended up on that critical radar in the first place. Silver is in high reliability electrical contacts. It's in advanced soldering and brazing. It's used in certain defense applications where corrosion resistance and conductivity aren't optional. It shows up in medical equipment, water purification, and specialized coatings. And in the energy world, it's one of the metals that keeps the electrons moving efficiently when you're trying to convert sunlight into usable power at scale. So when you zoom out, silver isn't just a shiny coin. It's a tiny, essential piece of a massive modern machine. And that machine is getting bigger. This is where the supply side gets even more interesting. And it's new information a lot of people don't connect. The global silver market is not that large relative to global capital. We're talking about a metal where annual mining production is under 1 billion ounces. And a meaningful chunk of that is immediately consumed by industry. So if even a small slice of global investment money decides it wants exposure, the market can get overwhelmed fast. That's why silver is so jumpy. It's not because it's fake. It's because it's small, and in a small market, the marginal buyer has power. Now add one more layer, recycling. Yes, silver gets recycled. But recycling isn't a magic faucet either. A lot of silver ends up dispersed in electronics and industrial products where it's expensive to recover. So recycling rises when prices rise, but it doesn't instantly fix shortages. It's more like a pressure valve than a solution. And that means tightness can persist longer than people expect, which is exactly why the retail chaos is worth taking seriously. It might look like noise, but it can be the visible symptom of a deeper imbalance. And if that imbalance is real, the next twist could catch even seasoned investors off guard. Now, I'm not here to tell you every dollar move is real demand. Let's be honest. When a market hits headlines, speculators show up. They always do. Fast money chases momentum like a dog chasing a car. But what's different this time is that you can see signs that the physical side is actually driving the engine, not just riding on top of it. And I'm going to show you why, without the hype. First, let's talk about retail, because retail is doing something weird right now. Over the last few years, a lot of people were net sellers. They were cashing out. They were paying bills. They were taking profits. They were getting tired of holding something that didn't do anything. And now, suddenly, that same segment of the market is waking up at the exact same time. Not just buying, selling and buying hard at the same time. That sounds impossible, but it's real. It's like a crowded room where half the people are trying to leave and the other half are trying to get in, and the doorway is getting narrower by the hour. A respected major dealer, one of those big names that doesn't need to scream to get attention, described the retail environment as pure chaos right now. And when someone like that uses language like, "This is bigger than what we saw during the pandemic panic," you should not shrug that off. Because you remember the pandemic metal frenzy, right? Back then, people weren't calmly comparing premiums on a spreadsheet. They were refreshing pages like it was a concert ticket drop. They were calling shops that didn't even pick up. They were paying whatever the ask was because they didn't want to be the person who waited one more day. So if a dealer is saying the retail demand wave has matched, and in recent weeks even surpassed, that era, then we're not talking about a little bump. We're talking about a psychological shift, and psychological shifts are what create the big, lasting moves. Here's the cliffhanger, though. Retail alone doesn't do this. Retail is the spark, not the furnace. So if retail is getting loud again, what's happening in the bigger channels of demand? That's the part most people aren't digging into, and it matters more than the price. Let's zoom out. Silver is one of the weirdest metals on Earth because it lives two lives at the same time. It's money to some people, it's an industrial necessity to others, and it's a critical input to industries that don't care what you think it should cost. They care whether they can get it. Based on recently published numbers, industrial demand has been leaning heavier and heavier on silver for things like solar panels, power electronics, medical tech, and advanced sensors. And solar is the one that keeps sneaking up on people, because the average investor hears solar and thinks it's a trendy talking point. But the manufacturers hear solar and think billions of units and supply contracts. When you build out power generation at scale, you don't get to skip the metal because the price went up. You either secure the supply, or you lose market share, or you shut lines down. That's why, even in a market where speculators are throwing gasoline, the underlying fire can still be the physical requirement. Now, here's another angle that almost nobody connects until it's too late. Silver doesn't just have demand pressure, it has supply friction. Unlike gold, silver is often produced as a byproduct of mining for other metals. That means you can't just snap your fingers and turn on a bunch of new silver production because price went higher. If the lead mine isn't expanding, or the copper project is delayed, or the permit is stuck, the silver doesn't magically appear. So when demand surges quickly, supply can't respond quickly. And when supply can't respond quickly, the market does the only thing it can do. It rations, through price, or through empty shelves, sometimes both. Now let's bring it back to that international price gap. People look at silver above $100 here, above $128 there, and they assume it's a simple currency thing. But there's another interpretation that's more unsettling. It can be a signal of localized scarcity. It can be a signal of different inventory levels. It can be a signal of different rules around imports and exports. And yes, it can be a signal that some parts of the world are more aggressively securing supply than others. From recent market updates, there have been increasing conversations about stock levels in certain regions getting uncomfortable.